why is Home Depot up so much on a day where they did cut their comp guide?
Yeah, I think there's basically three reasons why Home Depot is up. One, expectations were low. We heard as low as a 1% to 2% comp. They did a 3% in the U.S., which is very strong. The second thing is cyclical, right? Rates are down. We're going to lap existing home sales down high single digits in the back half of the year. It's up 1% to 2% in recent months. So investors saying we've taken the brunt of that decline in existing home sales and affects the business on a lag basis. So we're only going to get better. And the last thing is really the U.S. consumer is the best house on the block in many ways, with core retail sales, while about 120 basis points lower than last year. It's stable in this 3.5% to 4% range. And if that tariff risk is now going away, perhaps, we need to get there. And Home Depot is a best-in-class duopoly with an Amazon moat, and investors need to own it.
Yep. Interesting. John, some pointed to buying conditions out of the UMich survey the other day, where they said big household items were the lowest since 2015. But investors looking past that on this print, at least.
Yeah, sure. I think Chris deals more with the bigger ticket retailers than I do, but I agree with him that the consumer is very strong. The wages picture, the jobs picture is very strong. You do have a very difficult top-line comparison in retail for the fourth quarter. We had our cycle best spending in the fourth quarter last year. So difficult comparison going in the back half of the year. You do have tariff uncertainty, but the consumer is strong. We're seeing that in the winners that are scaling at an accelerating rate in retail, like in my space, the Nikes, the Lululemons, the VF Corps. It's the weaker channels of retail, like the department stores, that are losing market share at an accelerating rate. So consumer strong, but retail is very bifurcated.
What happened, John, with the TJX quarter? Not sort of the standout that we've come to see from TJ Maxx.
Yeah, sure. They comped at 2. People were looking for 3. Softlines retail is in a very competitive space right now. There's a lot of new competition scaling, like resale markets. The department stores are very promotional. There's a lot of inventory. One of the issues we see going in the back half of the year is inventory in softline space is very elevated. It's going to put pressure on margins, and right now TJX is in a competitive fight for market share. Their home goods concept also comped flat. That was the worst comp that we've seen out of home goods since 2009. So we're also keeping an eye on that category.
What's the reason for that inventory being higher than might have been anticipated?
It's really concentrated in the brick and mortar space, particularly in the department stores. I think they came out of holiday last year, and we saw very robust traffic and sell-throughs. People just bought poorly, and the consumer, weather-wise, did not agree seasonally with the calendar, and ultimately we're in an over-inventory position. And the consumer has a lot of choice right now, whether it's digital, Amazon, the resale market, the direct-to-consumer, the e-commerce platforms, a lot of brands. There's just a lot of choice for the consumer right now. There's too much inventory in the brick and mortar channel. It's going to get marked down.
Yeah, I was going to say, Chris, people have been watching rail car loads coming down pretty consistently. The narrative is that these retailers are going to be more than happy to let inventories come down and not putting a lot of trust in the consumer going into holiday. What's wrong with that, if anything?
Well, I think if you look over the arc of 17 and 18, where the consumer was accelerating, a lot of retailers were actually chasing inventory. So they had optimal gross margins, and into this deceleration that we've seen in the first half of 2019, I think a lot of retailers were not prepared for that. And you are seeing this dislocation, as John mentioned, the apparel channel, where there's share shift, and that structural headwind and the movement online is impacting that category the most. I think the risk is, as you look forward, actually, that sales moderated into the back half of the year. And if you recall, December, the consumer basically shut down when that stock market shuttered for about 2 weeks. So the risk is that they could get too lean as you get into November and December. But, in the world of a highly marked down prone category like apparel, that's a long way away. And most of these stocks, until you see that inventory clean up, there'll be a lot of weight on that category.
So, Chris, what's baked in right now in terms of a tariff increase on the remaining $300 billion, which would include apparel and footwear, and has now been punted to December, in terms of the share prices?
Yeah, so I think it's very dependent on which company and which category you're talking about. Home Depot essentially put 25 basis points of comp risk into the year for the potential tariff. Walmart put something in that number, but better than expected comps that they're seeing, the momentum in the business and in earnings, good SG&A control allowed them to again raise for the year and not really lower for the back half of the year. You know, the real risk around tariff, there's some in September, but most of these goods for the holiday are in inventory. They are in retailers' distribution centers. So it's really whether or not the December 15th tariff goes on, and that's when you see heightened apparel, you see heightened electronics. So really the risk around tariffs, I think, is very manageable. We estimate the average retailer will only have to raise prices 5 to 7%, and that's assuming that the vendors don't help them out. So it's really going to be a question of what happens in 2020, because if they don't go away, that's a whole nother discussion. The market's not looking forward to that. And so I think the biggest categories that people are focused on right now is, again, the apparel land. So it's a bit of a pylon between the inventory, the disintermediation of online, and the slower trends in the category.